Good afternoon, everybody here at AGSI offices in Washington. Good morning, good afternoon, good evening to everyone in our online audience. I'm Doug Silliman, the president of the Arab Gulf States Institute, and I'm really happy to welcome you all here to our final program of 2024 as we go into the holiday season. Now, we at AGSI tend to think of ourselves as a family, and as a family, what you do is you, during the holidays, bring together your best friends and you talk about all the important things that are going on in your family. But being really geeky people who think about the Middle East, we wanted to bring our good friends from the International Monetary Fund and talk about economic development and the economic divisions of our favorite clients in the Gulf. So I don't want to belabor this at all and turn this over to Tim Callen, our senior visiting fellow, to introduce our speakers and to start the program. So Tim?
Good.
It's all yours.
Thank you very much, Ambassador, and let me just add my welcome as well. I'm delighted to welcome back Amine, the Saudi mission chief at the IMF and head of the GCC division, and welcome Ken Miyajima, senior economist on Qatar at the IMF and co-lead of the paper on the GCC that we're going to be discussing today. This is hot off the press. The IMF just published this morning their annual report on the economic prospects and policy priorities for the GCC. So both in the room and online, you have very early access to the analysis and the further details that Ken and Amine will provide. So without delaying further, Ken's going to briefly go through the paper with the presentation, and then we'll go to questions and answers, both in the room and online. Online, if you could please put in your questions early so we can try and get to as many as possible. We've posted in the chat the paper and also the presentation for those online, if you prefer to open it rather than look at it through the camera here, please do that. So without further ado, let me hand it over to Ken to talk us through the IMF analysis of the prospects and policy challenges in the GCC region. Ken.
Thank you very much, Doug. Thank you very much, Tim. I'm Ken Miyajima from the IMF. So this year's surveillance note was another team effort of the GCC division members, this time led by two authors, and the other colleague, Balash Chonto, who is the deputy director of the newly established regional office of the IMF in Riyadh, is not here. So with this, in the next 15 minutes or so, we are going to discuss how the GCC countries have successfully weathered recent turbulence in the Middle East. And their economic prospects remain favorable, with some challenging medium-term risks in the context of geoeconomic fragmentation and the global climate transition, which call for action on policy priorities. So starting from regional recent developments, over the past years, spillovers from regional conflicts on the GCC countries have been limited, with trade, tourism, and the investment flows remaining largely unaffected. So for instance, the left panel shows export volumes from the main GCC ports over the past several years, from January to December. The green line representing 2023 shows that in the last quarter of last year, export volumes dropped, but then the red line shows in 2024 they have recovered so far. The middle panel shows that flight arrivals have held up well, supported by strong momentum in tourism. And finally, global investor sentiment towards the GCC countries have held up well, gauging from high-frequency indicators of portfolio inflows. So, consistent with the observed resilience, non-hydrocarbon economic activity has been strong, supported by ongoing policy efforts, of course, continued recovery in tourism, capital inflows, and increased capital spending. Overall growth was, however, weaker due to oil production cuts. Inflation was contained, helped by the appropriate monetary policy tightening earlier, consistent with the currency pegs to the US dollar. And tight monetary policy and financial conditions domestically meant slower credit growth, even though, for instance, in Saudi Arabia, credit growth remained double digit owing to corporate loans and strong mortgage lending supported by the Saudi housing program. And overall, the banking system remained strong across the region with robust asset quality, solvency, and profitability. Moving on to fiscal, overall fiscal surpluses narrowed in 2023 on account of production cuts and lower revenues. The fiscal stance, as measured by the non-hydrocarbon primary balance to non-hydrocarbon GDP, the indicator also loosened in many cases by 1 to 2 percentage points of non-hydrocarbon GDP, which is the left panel, except for Oman, where the fiscal stance tightened by 3 percentage points. Central government debt as a share of GDP was broadly unchanged in 2023 in the region. Moving on to external sector developments, current account surpluses narrowed again on oil production cuts, but also on investment-related imports. But they remained at sizable 12% of GDP on average in 2023. In addition to this, portfolio inflows were boosted by the issuance of international bonds by sovereigns and sovereign wealth funds, IPOs, and also by the increasing weight of the GCC countries in emerging market bond and equity indices. So these surpluses and capital inflows were in turn invested abroad, accumulated as central bank reserves, and also used to extend financial support to foreign countries. Now, economic diversification is, of course, a key objective of the visions and national development strategies in the GCC countries. Progress on this front has been steady, but more needs to be done, particularly to broaden export and fiscal revenues, an issue that we will touch upon later more in detail. Now, outlook and risks. So first, let me clarify here that our projections are based on the announced oil production plans. The latest announcement or announced plan is not reflected in this vintage of projections. It will be reflected in the upcoming vintage of our projections. So with this, over the medium term, overall growth will benefit from stronger non-hydrocarbon activity on the back of reform implementation and robust hydrocarbon sector owing to anticipated unwinding of oil production cuts and also expansion of natural gas production. Current account surplus will remain strong, with central bank reserves holding steady. Of course, the overall financial assets of these countries are significantly larger when sovereign wealth funds are included in the metric, in the calculation. So risks around the relatively favorable outlook are broadly balanced in the near term. Long-term risks stemming from including geoeconomic fragmentation, global energy transition, are more challenging, and they call for taking action on policy priorities. So what are the policy priorities? I will talk through fiscal and structural priorities using the following several slides. And for the benefit of time, just let me highlight a few from here. On monetary policy, the currency pegs are appropriate and should be maintained. On financial sector policies, banks are strong in general, but risks need to be monitored and managed well. So first, moving on to fiscal policy priorities. So over the medium term, the overall fiscal surpluses or the balance as a share of GDP is expected to gradually, it's not shown here, but expected to gradually narrow as hydrocarbon revenues are expected to moderate. However, the fiscal stance as measured by non-hydrocarbon primary balance as a share of non-hydrocarbon GDP is expected to tighten. So the table on the right, the first column, shows that the projected cumulative fiscal tightening over the medium term can be up to 10 percentage points in some countries or even more. So this underpins the projections in the left panel that the debt to GDP ratios are going to stay relatively moderate. And yet, except for Qatar, additional fiscal consolidation is needed, as summarized in the second column of the table on the right. So, fiscal consolidation. How we do it? The first, fiscal consolidation needs to be supported by supported by revenue mobilization from non-oil resources. So the panel on the left shows that the GCC countries have a significant upside to mobilize non-oil tax revenues, which is the blue area, including through VAT, CIT, and also by improving tax administration. On CIT, many GCC countries have announced their intentions to introduce Pillar 2 global minimum tax starting from early 2025, which is a welcome development to help raise more revenues and increase tax efficiency. Fiscal consolidation should be also supported by expenditure rationalization and greater expenditure efficiency. Looking at the wage bill, which is an important expenditure component, the left panel shows that the spending item was not particularly high in 2022, but can also become cyclically large in relative terms along the oil cycle. Also in the long term, strong population growth in the GCC means that wage bill can increase over time. So those together call for wage bill rationalization and also boosting employment opportunities in the private sector to absorb nationals, especially in countries where the nationals tend to be hired by the public sector. Rationalizing subsidies is another important area for the GCC, which can generate fiscal savings and also promote efficient utility consumption and support climate ambition. Moving on to structural reform priorities. Across the GCC, growth potential is held back by several factors, including low TFP growth, moderate foreign capital inflows, and segmented labor markets. So here, zooming into TFP growth and its key drivers. The GCC has already advanced digitalization and they do well in macro stability. So additional gains from those two components will be very welcome, but the gains may not be as significant. Trade complexity could be a promising area. because the GCC countries' economic complexity and export complexity are both relatively low. So there's a lot of upside to improve, and gains from a given improvement is estimated to be relatively large. Another area is for the GCC countries to reduce their large state footprint, where the impact of a given reduction in state footprint is estimated to be also large. By the way, the latest regional economic outlook produced by our department, the Middle East and Central Asia Department, includes a chapter which discusses how lower state footprint can facilitate development, financial sector development, and therefore improve TFP growth. The GCC countries have made significant efforts to enhance trade and financial sector integrations. As many GCC countries pursue similar objectives, such as boosting tourism, and building data centers and the like, strengthening regional integration could be a way to reap the greatest gains together. Also, progress on this front would enhance resilience to a shock. So this year's note looked specifically at intra-regional trade integration. One finding is that, as in the left panel, the GCC has room to boost intra-regional trade by further reducing non-tariff measures. Given the importance of FDI for economic diversification, the GCC authorities have launched initiatives to increase their attractiveness for foreign investors. So the right panel shows that FDI inflows increased in recent years, and this trend should continue by enhancing the pull factors, including financial depth, human capital, institutions, and labor market mobility. As the GCC countries continue to implement their reform agendas, close attention needs to be paid to associated risks. So, for instance, as they continue to implement industrial policy measures to diversify the economy, such measures should target market and capability failures, minimize distortions, and ensure compliance with multilateral rules. As another example, as inward capital flows, especially FDI, remain modest, in some GCC countries, the sovereign wealth funds have increased their contributions to domestic economic development. However, their high-year domestic exposures could have some side effects, including reduced ability to protect their financial wealth going forward. So this concludes our presentation. Thank you very much.
Thank you very much, Ken. And as a reminder to those watching online, please submit questions in the room. If you have a question, please just raise your hand and I'll get to you. Maybe I can just kick off with the first couple of questions. The first one on the outlook for the GCC. I guess your projections have growth in the non-hydrocarbon sector remaining relatively strong, 3.5%, maybe edging up towards 4% a year. Yeah, as you've highlighted, there's also fiscal consolidation going forward in the projections, and I guess we usually think of the GCC as the fiscal, particularly government spending, driving growth in the non-oil sector. So maybe you could elaborate a little bit on how you see the fiscal consolidation, or why you see the fiscal consolidation not really impacting the growth outlook.
Thank you, Tim, and I'll start, and I think Ken may continue if he has more. And first, good to be back here. I'm glad this is your last seminar before the holidays, and then maybe we can all go on holidays after this. But thanks for having us for this. On your question, look, the link that was there between public spending or central government spending and growth, non-oil growth, non-hydrocarbon growth is not as strong today as it used to be. A lot of that is because a lot of the spending is also done by entities outside the central government, particularly the sovereign wealth funds. Now we have a lot of these sovereign wealth funds that are spending a lot more domestically. Some of those programs have not been cut. I mean, some of the funding, you've seen PIF in Saudi Arabia, for example, still going out there getting funding. It still has a $40 billion a year in terms of its investment. That's going to help prop up domestic demand. And at the same time, in all of those economies, there's a vision, there's reforms that are being implemented, and that is sustaining domestic demand, and that is sustaining non-oil growth remaining at 4% and above, depending on the country in the GCC. So that's the reason why we have that forecast. Now, you didn't ask, but you will see, and it's not a scoop, but you'll see in our next WEO update that on overall growth, the numbers will be revised again because of the oil production, OPEC plus oil production cut extension. But we will likely not revise as much non-oil growth because we think those factors will still remain, at least in the near term. And Ken, I don't know if you wanted to add something to this.
No, I agree. Yes.
So maybe let me just follow up there with a question. So I guess, as you said, you assume the OPEC plus production schedule that's been delayed going out, so there'll be a small change probably in the near-term forecast when you update. Could you maybe just outline what you assume for oil prices over the medium term? And then maybe also just discuss, I think you highlighted one of the risks as being the oil prices, maybe how you see, an environment maybe of substantially lower oil prices for a year or two affecting the outlook.
As a former IMF staff, I'm surprised at this question, Tim. You know that we don't have models, that we don't use the models to project the oil price. We have them, but we use the futures. And futures are basically showing that the curve has really been flattening. Clearly, next year, oil price now is around $70. It used to be 70, 72. It used to be around 78 only like a few months ago. And, stabilizing around 70, 69 dollars. So this is, in terms of the price. Now, the question we have, and we at the IMF are looking at, because we're using the futures, and we're not using the futures, is also already anticipating what the market is expecting. And what the market is expecting may not necessarily but what we have in our projections, because the market, given the slack in the oil that's expected, is not expecting the OPEC plus extension to just be 3 months for the 2.2 million barrels. It's expecting it to be larger, because if that were to come, then the oil price was likely going to be lower than the $70. That's assumed so far. So right now, this is something we will look at for next year, in whether, to make sure that there's a consistency between the oil price and production on what should be the production path. But, clearly, this is the 5th time that OPEC Plus has extended the oil cuts. 5th time you've seen us revise oil production and overall GDP, but we didn't do that for non-oil GDP, or at least the revisions were a little bit lower. So this is on going forward. On the impact, obviously this is going to be narrowing, increasing the fiscal deficits for countries that are in deficit, narrowing or lowering the overall fiscal balance, and going forward also the same thing in terms of the external situation, but reserves are ample and quite comfortable for all of the countries in the region.
Just as a reminder, if the slides were hard to see for people online, we have circulated the slides in the chat, so please feel free to look at them as you listen to the questions and answers online. Are there any questions in the room? Yes, please. And could you wait for the mic and then just introduce yourself, please?
I'm Peter Humphrey, an intelligence analyst and a former diplomat. I'm wondering if Trump goes ahead with his promise dictate, drill baby drill, what the effect will be on you guys. I mean, certainly the idea is to generally cap prices. But does that mean you cap your production to compensate for his increased production?
Who wants to tackle that?
I can take it. Look, I mean, it's unclear yet what will be the impact of this policy and how much in terms of growth that will lead into oil production. You know, a lot of the increase in oil production in the U.S. Has happened during the Biden administration. You had oil is now at 13.5 million barrels a day. In terms of production in the U.S., that's a record high. In some years we've seen increases over the past 4 years of 1.2 million barrels a day for U.S. production, which made non-OPEC plus a much larger component of the supply growth, and this is why you're seeing a lot of more slack in the market today. Now, going forward, how much of these new investment decisions will affect the oil market in terms of oil production? How much, we've seen in the past that clearly shale oil firms can be produced now much more efficiently than in the past, and maybe can tolerate even lower oil prices. But also shale oil production, shale oil companies, a lot of them are after profitability, wanting to keep cash. How much more growth can come? So it's not really clear. And I think on the oil market, the story is probably not only on supply, although that would affect, and then how would OPEC Plus react given the slack, is what's happening on demand. And so far on demand, the growth that used to be coming from China is not as strong as it used to. And therefore, if you look at IEA and a lot of these other agencies, there's not as much growth on the demand side, and therefore this is where the pressure on the supply comes. Because these non-OPEC plus countries, whereas US, Canada, Brazil, Guyana, are also producing a lot more than in the past. So this is why, where we're now going to look at this situation and see, in our forecast going forward, where do we expect oil production, particularly given that quite a few members of the GCC are also members of OPEC plus.
And I guess the other thing here as well is what will Trump do to clean energy, right? Alternate energy, both in terms of supply and demand, which will be another factor, ultimately affecting, I think, the demand for oil. Are there other questions in the room before I take a couple online? Yeah, please.
Cody Combs, future editor for The National. You talk a lot about, or a little about, artificial intelligence and how it could bolster the economies of the UAE, Saudi Arabia, and how it could increase GDP. I was wondering if you could extrapolate on how it could increase exactly the GDP, and if you had any idea which countries in the GCC might be most vulnerable to exposure of AI, the downside of it.
Take that?
Okay, well, thank you. So we did the analysis on the impact of AI through labor market in the context of Qatar. Other country teams have done similar analysis as well. But specifically for Qatar, it really depends. Well, in general, it depends on the mixture of skill set and job opportunities, sectoral distribution, and so on. Specifically for Qatar, the way the jobs are distributed among expatriate workers and nationals, the upshot was that there are a lot of jobs with exposures, but also a lot of complementarities. So in such cases, the overall impact of AI on labor market jobs and probably on economic activity as well will be overall positive. So in this case, these countries can be considered to be positioned well for a future development in AI.
And we have another paper actually coming out in about a month on digitalization in the GCC, where clearly you see there's quite a lot of advances that have happened, and AI could help boost productivity and affect growth and labor productivity. And we've seen that, the study on Qatar, we've done that on Saudi Arabia. But what's important is that to accompany that growth, you need all those prerequisites to also be there. So it's not just investing in AI, but you need that human capital, you need that infrastructure to be there. All these data centers, it's great in terms of infrastructure, but at the end, in terms of benefiting for growth, I think it's quite important for those other prerequisites to be there. And hopefully we'll get that analysis out pretty soon.
Let me take a question online. So it says, how do you square the progress on diversification with higher break-even oil prices in countries like Saudi Arabia? Some economists say this is evidence that they rely more on oil, not less now.
Well, when you look at all measures of diversification, and clearly, if you look at where all of the GCC countries are over the last 20 years, and we have a box on that, we have some analysis on individual countries in the GCC. If you look at the metric in terms of share of oil in output, if you look at share of oil in exports or share of oil in revenue, because of the measures taken, that has all decreased. Now, some of the questions that are coming is usually because a lot of people link the non-oil sector to oil because of the usual recycling of petrodollars, etc., in the economy. I mean, that exposure is still there, but it's like much weaker than it used to be. If you were to look at the synchronicity of what's happening to oil, non-oil GDP, both in terms of growth and share over the years and in the link with the oil price, that has gone down. So there's been some progress. And I think the fact that reforms are happening and that these visions are being implemented are part of this breaking of the link. And this is, again, we will have now a case in point if oil prices continue to soften and to try to see how long that will continue. We've seen some of the sovereign wealth funds play a counter-cyclical role, but we've seen that there's been, in some of the countries, central governments that have announced that, there's going to be lower spending than what was originally budgeted, or at least in the originally program, at least in the new budget. I mean, case in point in Saudi Arabia. But some of the other spending from the sovereign wealth fund and others is continuing. So it's still too early to see where that's going to go. But I think clearly the pattern has been that diversification is happening. And I think our message has been that all of these reforms that many of these countries have done, both whether you look at it for encouraging private sector, improving the business climates, and et cetera, should continue irrespective of what's happening in the oil price. And I think that's quite important to maintain the reform momentum for diversification.
And maybe, Amine, could you add a little bit about factors driving the break-even oil price? I think as we've discussed, it's an imperfect measure, I think, in many people's views, right, of the reliance on oil revenues and the current account and in the government budget.
Look, I think you wrote a piece on that, which I agree with, which is, break-even oil price is really an imperfect measure. Break-even oil price, for example, on the fiscal side, it would really only tell you what's happening at the current point in time. And it depends on many factors, what's happening on oil production, what is happening on non-oil revenue mobilization. And then, so all of those factors don't really represent what it is. I mean, take the example of Saudi Arabia. They have this voluntary cut of 1 million barrels a day. They had other cuts that they were done, like you were just 2 years and a half ago, they were producing at 11.5 million barrels a day. Today it's 9 million barrels a day. Obviously, the break-even oil price is now going to be much higher. But if they get back to higher production, that could also change the situation. This is why we've been arguing for all of our countries that what matters is what is the medium-term fiscal framework, where is the medium-term plan and the medium-term sustainability, and trying to see where is the fiscal stance going to be there, and can they sustain that over the medium term, even if oil prices were to decrease. So I'll answer you there, but I see a lot of imperfection on the break-even oil price, even though the press and many analysts like to really focus on that.
It's a simple headline-grabbing number with
Yes.
a lot of imperfections, I think. Looks like, Doug, you have a question.
I've got a pair of questions about government expenditure trends and government revenue trends, because the simplest but the most politically difficult changes the Gulf governments need to make is in reduction of subsidies, but also generating of new revenue. So my question is more one, what kind of advice? Do you have one or two things that you are advising Gulf governments to increase revenue, a particular policy or percentages, and what are you advising on how to approach reduction of subsidies?
Look, I think in all countries in the GCC, there's a lot of room on revenue. There's been progress compared to what it was a few years ago. But this is what happens with this is why the tax gap for the region as a whole is 15% of GDP, for some countries less. There's, some countries have introduced the VAT. Some Saudi has it at 15%, others have it at 5%. There's no uniformity there. There's quite a lot of room there. So, there's a lot of room on VAT, property taxes, personal income tax. And actually, coming back to the question on diversification, this will help sustain the spending that is needed over the medium term. And it's good to introduce some of those measures now in good time. In a lot of the countries in the Gulf, you have a construction boom going on. It's good to have a property tax to capture some of that activity. And I think a lot of those measures will be important to stand on. Now, to your question about I think it's happening at different degrees. I think Ken did mention, for example, and I think this is an excellent initiative with what's happening with the Pillar 2 of the global minimum income tax, to make sure that at least any leakages is captured by the GCC countries and not jurisdictions that are outside. And I think those are some of the trends there. Now, on spending, you've seen the numbers on subsidies. They go from 5, 10%, depending what you include on it. There's a lot of room there. I think it's still part of the social contract. I think this is something that's difficult to remove, but, UAE doesn't have energy subsidies. It's an example for the rest because it has liberalized. And I think, the fact that some of those countries have these regular price adjustments and they're moving there. I mean, Saudi Arabia has increased earlier in 24 diesel prices by 53%, right? And I think our message has been it's important to remove those subsidies and also at the same time increase some of the social safety nets. And that is happening, and that can happen in many of the GCC countries because they have they have some targeted mechanisms that can really reach the population with digitalization. And, in many countries, the reason social safety nets don't work out is you can't really reach the beneficiaries and you can't identify them. And in many of the GCC countries, that's an issue that is not there. So it's a question of having the right program and deciding what's the target population to make sure that these inefficient subsidies that benefit the richest households are not there. And you talked about government spending. I think subsidy is one, but I think, like Ken mentioned, it's important to also, in many of the countries, the public sector wage bill is quite large. And there's quite a lot that can be done there just, by attrition. And a lot of these governments are doing that by also encouraging the new educated to go to the private sector. And there's some also targets there for the private sector. But I think that is also going to be for central government a source of saving. And, but one thing that I think hasn't yet come out in the discussion that I think would be good to emphasize is that we've been talking about central government, but it's quite important to look at the whole public sector balance sheet. And as a lot of these sovereign wealth funds and other entities start to take a role, a more important role in the economy, it's quite important to also have a good view of what's happening there and to make sure we're not shifting from one entity to the other.
So maybe I can take the opportunity of you raising safety nets to get into a question online. It says, do you think the GCC countries are facing social equity issues and how this is affecting their economic transitions? And I guess, as you've said, we've seen more taxation, reduction of subsidies, maybe more focus on employment, particularly of young people in the private sector rather than the government. How are they tackling issues of social equity within these changes?
I mean, good question. I think, social contract is changing a bit because there's less assured jobs in the government sector that used to be in the past in some of those countries. But at the same time, if you look at the increase in spending, for example, in Saudi Arabia, clearly we've seen social spending going up. When some of the programs were introduced, like in Saudi Arabia for the VAT, you have the Citizens Program. That was an untargeted program that was benefiting a large part of the population. And now, that is being more targeted and narrow so that you can benefit the most vulnerable. And I think they have now more targeted programs that are there. I think a lot of these social spending are also, or safety nets or social transfer programs are also being designed to try to offset some of the increases in either taxes or removal of subsidies. And you've also seen some of the labor law amendments. For example, we've seen for the new pension reform law in Saudi Arabia that also gives the contributions for the pension coming from the private sector employers to make sure that the pension is also paid. So there amendments are there to also adapt to the change in the structure of the economy as it's happening.
Okay. Yes, please.
Hi, thank you for doing this. Valentina Pasquali, I'm senior editor with AGBI, Arabian Gulf Business Insight. I have two questions, but they are related. Anyway, let me start with the first one on taxes. I wanted to ask you to focus a bit more on the personal income tax side of the equation. There was movement in Oman that got delayed. There's discussion about perhaps other countries needing to adopt them. Do you see that as an important part of what you're discussing? Is it just a nice add-on? What is your view on that?
Look, any measures that will help diversify and increase, will help diversify the economy and increase the revenue base, I think would be important. Clearly, personal income tax is one of the sources, but there's also a lot, even in widening the base, removing some of the exemptions. I mean, VAT, personal income tax is 0% in some of these countries. And there's quite a lot of room. So it's a question, at the end, what can work now and be politically palatable and how you can get that. And PIT should be part of the package. The question is, when is that coming in? As long as a lot of these different tax bases are also being looked at. I mean, I think what's important, for example, if you look at in a lot of our countries, the non-oil revenue over non-oil GDP is not really increasing because we don't have a lot of new measures. I think it's important that they continue being implemented, and particularly that now is still a relatively good time. You don't want to introduce those measures when you need them. You want them to have them already there so that you can have the extra buffer when needed.
Yep. Maybe just add to that, I think different countries have maybe different preferences over which ones to introduce first, and there are probably, if I may say, lower hanging fruit. Introducing VAT in some countries could go first, and then this kind of momentum, social understanding, dialogue can continue to go to PIT, but there are probably different things they can go first as well. Thank you.
You had a second question you want to say?
thought that was 2 questions.
Sorry. The second question is going back to the beginning on geopolitics. You've mentioned that the GCC states have, by and large, weathered all of the issues in the region fairly well. Do you expect that to continue? What kind of things are you monitoring in terms of possible leakages to the economies in the GCC next year?
Thank you. Look, if we look at the GCC, it has been resilient. A lot of what's happening in the region, tension, if you look at the trade links, the financial links, they're really low. We've seen, the Red Sea, the tensions in the Red Sea. Clearly, there was some diversion at some point, and some of the ports, other ports were used a lot more. But I think that was a temporary shock that seems to have been, resolved. And if you look at, oil cargoes and etc., these have not been affected. So far we're not expecting a big change. Of course, we can't predict the future, but the impact of the increased tensions have so far been quite limited, and I would say because the links are very weak.
Can I follow up on that?
Please.
Let me answer a little bit about that from the standpoint of the Gulf economies. They are very worried about regional instability because they are mostly all focused on developing their own economic systems, implementing their visions. And in geopolitics, you've seen over the last 2 or 3 years a move by 5 of the 6 GCC states to enter what I call sort of a détente-like relationship with Iran. It's neither hostility nor peace, but the Saudis have restored diplomatic relations, the Emiratis did a bit before, and only the Bahrainis have stayed back from that. I can see a possibility where a Trump 2.0 ultimate maximum pressure sort of campaign increases tension that could have an economic impact on the Gulf. But again, it's very hard to say because what Amine says, the links are not so direct economically, but will political instability, will there be a difference or refocusing of attacks from Ansar Allah in Yemen on Saudi Arabia or the UAE or elsewhere in the region that could have sort of knock-on economic effects? We just don't know yet. So I would watch the strength of the relations between the GCC states and Iran and their ability to keep the tensions low as one indicator of what an increase in tensions or Syria or Gaza or Lebanon might have on the region.
So we have a number of questions on revenue. I guess this is a hot topic at the moment. But so first one, you had a nice annex on the global minimum tax, which you'd mentioned. I guess the question is how the obligations that the GCC countries have made under that are consistent with a lot of the tax incentives that they seem to be offering multinationals, whether through free zones, a regional headquarters program in Saudi. So maybe you could comment one on that. Second question, you mentioned property tax. But given a lot of the boom in the region is driven by government-related enterprises and quasi-sovereign entities, how would that really help? So I guess is it a tax on private real estate ownership, or exactly what's the structure of that? And then this is maybe not so much a question, but I guess a point of view. It says all the fiscal recommendations are based on the Western vision of the economy, VAT, income tax, reduction of government salaries. But the Western economies generally have much worse fiscal positions than the GCC. So, I guess just highlighting that and say, question about the model that's being used.
Thank you. I'll take all of them, including the comment. On the global minimum income tax and Pillar 2, I think, that's a good point. I think this is why it's important to do a good inventory, a stock taking of all the incentives given. I think, Saudi Arabia, the RHQ, the incentives there are mostly for RHQs to be there, but not incentives on all company operations and production. And the whole point, and this is why it's important that the countries have agreed to look at top-up, is that they're going to look at the incentives and try to see what is it that needs to be done to make sure that the leakages don't happen to other countries. So I think some of the countries, some of the officials are saying that even when the incentives are designed, they also look at that to make sure that the 15% is also respected. Remember that for some countries, foreign firms, for example, in Saudi Arabia are charged 20%, right? So that's already above the 15%. And then how low would the incentives take them? And not that we're not huge fans of incentives, so the less there are, we think the better. But I think that's the whole point of this, is to ensure that the incentives that are given do not lower the corporate tax below 15% so that other jurisdictions benefit. And I think that's an important point. I think this is all going to benefit to the countries. On the property tax, I mean, the idea, I think some is, it's like on ownership. There's already probably on some real estate transactions, for example, in Saudi Arabia. But I think, if you look at it, emerging markets, property tax that comes in, it's not just Western and others, it's like 2% of GDP. I mean, that's already some of the revenue that can come in and help some of the countries. And, it's not the Western vision of the economy. I think this is, at the end, when you're trying to diversify, you're trying to get your non-oil base and try to extract some rent from that so that actually, you're going to have an energy transition. You're going to have times where oil price is low. You need to still have a base to continue your operation. And I think there's a lot of room there. I think, look, who would have thought 6-7 years ago, and you were mission chief then, that the VAT would be today at 15% in Saudi Arabia. But today it's accepted with the refund working, and it started low with the high threshold, etc. And I think, this is something that is helping provide some much needed revenue to social spending, to engage in some of the investment spending, etc. So I think it's a trend that will be worth pursuing. Of course, it needs to be explained because people are not used. If you don't want to pay taxes, now you get new taxes. This is something that needs to be explained, and the explanation also needs to put out there, what is the service delivery that is coming up? What are the extra services that will be there, and the risk that you're trying to avoid? So, I think, zakat is there in some cases, but you have, other types of taxes that can be introduced, and I think will be good to look at.
Other questions in the room? Please.
Hi, I'm Shamir. I think in addition to economic diversification, it is also necessary to ensure sustainable development. Mm-hmm. Since the energy is very available for cheap price in Gulf countries, the per capita energy consumption will be very high. That is negatively impact the environment. So one solution would be to increase the energy price, energy bill. But in short term, even though that is effective and beneficial in long term, in short term that will lead to popular mobilization against government. So this kind of dilemma, whether to increase energy bill or not, what will be its impact on environment, that would be a challenge, I think.
Agreed, and I think this is, it's important to look at what's the impact of that and to prepare the reform carefully, and this is why I think the GCC economies are actually a lot more prepared than a lot of the other countries in MENA that need to reform subsidies, because they have the resources and they have the capacity to target the vulnerable, so to accompany the reform with the social safety net that's needed to actually try to limit the impact on the vulnerable. I think that's something that many other countries do not have available.
Other questions in the room? Yes, please, go ahead.
This time on
I
spending.
want to take other people's time, but if nobody else is asking. I have a question on Saudi Arabia specifically.
Sure.
Putting together oil prices going forward, OPEC plus, non-OPEC plus, all of those issues. how much in a rush is Saudi Arabia right now to implement all of the Vision 2030 reforms, the big development? Does it still have good time? Is it really under pressure? Is it on pace? Can you give me a sense of how you're seeing that before oil goes too low? That's the...
I repeat the message that I think, the vision reform implementation should continue irrespective of what's happening in the oil price. I think, there's some external funding that's coming in. Sovereign bond issuances have increased rapidly in Saudi Arabia, both from central government but also from the PIF. As part of the vision and the vision realization plans, you have a whole set of investment spending that is there. There was a recalibration that was done. What we haven't seen is how has that recalibration affected the Vision 2030 plans and what the new investment plans are. But clearly, a lot of the projects are continuing. I mean, the PIF is still staying at $40 billion a year. You're going to have the Asia Games, the Asia Cup, the Expo, the World Cup, and a lot of the infrastructure that would be needed for that is also part of the vision. So I think it's important. At this stage, I think the funding is identified for some of the projects and throughout the medium-term enterprise. What's important, though, is to clarify for investors, if there is a change, what are the changes, what are the projects that have been impacted, so that investors can plan and have some more clarity on the investments that they need to bring. We talked about FDI, and I think FDI has been growing, but could be growing even faster, and I think that's something the authorities will be working on.
Let me put on the table 3 questions around trade and FDI that have come in online. So on FDI, I guess we're seeing different experiences across different countries in the Gulf. But, in those where maybe, FDI is lagging behind and the countries are trying to boost it, what are the policies that are key, in your view, to boosting FDI, and what impact, if any, has the conflicts in the region had in deterring investors? Then on the trade side, there's a question on free trade agreements, and both the EU and China want to conclude free trade agreements with the GCC. What are your views on these negotiations, and how do the GCC countries see these? And then lastly, at least vaguely related to trade, how are the GCC economies approaching industrial policy in light of the sustained global trade fragmentation?
All right. I can start, and I'll let Ken finish the difficult part. On FDI, lagging behind, I think it would be important to put things in perspective. I think FDI is lagging behind maybe certain expectations, particularly Saudi Arabia, where 2030 target is 5.7% of GDP. We're at 2.2. Some of that is coming from oil and energy. But for Saudi Arabia and some of the other countries, what's important is to look at the increases in FDI inflows. It still is going up much more, and the share of FDI coming to the GCC is more than going to other regions. It's one of the regions that has attracted FDI. Some of it is still related to hydrocarbon, and I think this is where some of the expectations are in terms of changes. At the end, financial sector deepening, human capital, favorable, business environment, and a lot of these countries are working on, really reforming the business, the commercial law, the civil code in terms of Saudi Arabia. There's a new foreign investment code that's going to be bringing more even-handed treatment for foreign investors and domestic investors. I think all of those will facilitate. Also takes a bit of time for the FDI to come in, so perception also needs to change. But the trend has been going up, but not yet in all the sectors to diversify. And I think, and maybe one thing that I would like to say on FDI is that it's not clear that incentives is what's needed, right? I mean, access to finance, human capital, those are really the quality of human capital. These are really what some of the firms are looking at. And if you look at some of the business enterprise surveys, it's not really the incentives that will bring that. On FTAs and GCC, I think the GCC is negotiating some of that. I think trade with other regions are quite important. But I think it's good that the GCC is negotiating as a bloc, as opposed to just each individual country. I think they will get more from the trade benefits if they negotiate as a whole bloc, because they are larger population, larger GDP growth, different sides of the economy. And, you know, here we are talking about intra-regional trade and these FTAs. I mean, one thing that we have in the paper that maybe I would like to attract attention, that would be important, is that there's a lot that can be done also on intra-regional trade within the GCC. It has increased from the 80s. It used to be $2-3 billion in terms of exports within the GCC in terms of goods. Today it's 70 billion, but that 70 billion is only 10% of intra-regional exports. That's a lot less than what we're seeing in Europe or other countries that are in the regional bloc. So there's the FTAs, but there's also intra-regional that can happen. On IPs, look, I think IP seems to be happening in many countries in the world, not just in the GCC. And I think it's important to look at the risks to make sure that these are phased out, these are not, if these are incentives based, that these are clearly evaluated, but also that you're not crowding out the private sector by trying to pick a certain sector and having state intervention. And I think, when we looked at productivity, and this is why it's important on when you have the state being very involved in picking a sector. And I think Ken showed a chart in the presentation on productivity, and state footprint had a very negative impact, right, on productivity. It was like digitalization, macro stability, etc. were really factoring productivity. So one has to be careful on IP that it's really done carefully to reduce those risks. Ken.
Thanks. Maybe to add a few things on FDI. So even making an assessment of lagging FDI, there's an issue with monitoring in terms of data quality in some countries. They don't have sufficient data to see how much FDI is coming and into which sectors. So and that is also important to assess the progress on visions and national development strategies as well. So I think the first step also is to get that part right before making an assessment. Actually, we cannot make any assessment without that. In the interim, some countries are relying on commercially available data on commitment-based FDIs. And also, in terms of how to leverage FDI, it's very important from cross-country experience that there's a knowledge spillover in the domestic economy. So some countries relied on natural companies to bring in technology, but that didn't work very well in some cases. And I think here the silver lining is that even though in terms of the level it's still low, there's a very steep increase in patent applications in some GCC countries. So if this trend continues, then domestic technology can be built domestically and create knowledge spillovers from technology that comes into the country. That would be a great way to leverage even a small amount of FDI in the first place. Thanks.
I wanted to just pick up on something you said, Amine. I thought there are two really interesting charts that you showed in the presentation were the contributions to total factor productivity, which showed the state footprint sort of taking away from productivity growth. And then you also showed the one on the sovereign wealth funds, which showed a much bigger concentration of their investments domestically in the GCC than in other regions. And then a third piece, you had an interesting presentation in the, I can't remember the name, but the TED talk that the IMF did at the annual meeting, showing that the multipliers of spending from sovereign wealth funds were lower than from foreign direct investment. So I guess all of that evidence is suggesting that, sort of we need to see a transition away from the public sector growth model to more of a private sector growth model. But many of the countries actually seem to have gone almost the other way, or at least have not really changed. The composition may have changed from government to sovereign wealth funds, but overall it hasn't changed. So I guess you're wondering what you see as a mechanism by which we see this needed transition to private sector, which may be a key thing in boosting productivity further.
I think if you look and you look at all the vision programs of all the countries in the GCC, I don't think there's one. I think all of them will say enhancing private sector development is one of the priorities. There's different ways of going about it. Clearly, I think if you look at some of them, the central government has less of a footprint than it used to. There's a bigger role for sovereign wealth fund. I know Saudi Arabia, the sovereign wealth fund is seen as private in terms of taking commercially driven decision. But again, it's still a sovereign wealth fund that has now $925 billion or more in assets and is involved in some of the sectors or protecting some sectors. So I guess the issue here is to make sure that the investment is done efficiently, well, choosing where it is. If you look at some of the sovereign wealth fund, initially, for example, the PIF was involved in seed capital for movie theaters because it was considered risky, and there were no movie theaters in Saudi Arabia. Then they removed the seed capital, and now movie theaters, they got out of it, and movie theaters are completely private. And those are the type of activities that will actually enhance efficiency and will have maybe a stronger multiplier. Now, if it's seen as crowding out private sector in some of the existing industry, et cetera, that could have less of an impact. The study that you're referring to by colleagues who will be coming out in 2-3 months, and maybe the authors can come and do that presentation here, is basically looking at sovereign wealth fund in general, where the fiscal multiplier there is about 0.4, 0.5, which is about the same as the central government. So in other words, it has an impact, but it's not so much higher in general. And I think because in some of those, it's not necessarily clear that it is done the most efficient way. On the other hand, that same study looked at FDI and also FDI in some of the new technology or emerging technology in renewable, for example, et cetera. And there the multiplier was closer to 1.2. But again, it's going to be depending on some of the projects. So to answer your question is, it's important that the project feasibility and project assessment that is engaged by the sovereign wealth fund be done as on a commercial basis as possible, including in trying to select the various projects. I think clearly, and if you can get some of the FDI coming in, and this is why the reforms that they have to try to spur FDI are quite important, because the numbers, the dynamics show that that will bring more growth.
You mentioned, Amine, the paper you're working on digitization, and I think you said on AI as well included in there. So the question, or a couple of questions come online in terms of how the development of the AI sector in the Gulf is going to affect energy demand there, and whether that is built into expectations in the forecast.
I haven't thought fully on that. I know that there's a lot of the countries in the Gulf looking at this as a model of future growth. investing in the data centers and then becoming an export of that. And a lot of these data centers require a lot of energy, and the availability of cheap energy in the Gulf, I think, makes it a good location for that. And but how that will affect, energy demand in particular, I haven't really looked at that carefully. But Ken.
Maybe a little bit related comment is that how this is part of the diversification. So one way to think about it is, yes, this is non-oil, maybe, but then the other is that this is just another way of using energy and exporting energy in just a different way. And yet another question is, so some countries' development strategy was to use relatively cheap labor and then move up the value chain. Whether this can be done with cheap energy in the same way to move up the path of development. So this is something which is, we are sort of thinking about how this fits in the diversification strategy and so, going forward. Thanks.
Are there any other questions in the room? Okay, go ahead, Doug, please.
You talked a bit about Saudi Vision 2030 before. My question is for the other 5 visions and development plans. Have any of these development plans taken a hit with low oil prices, or are they all chugging forward at about the same rate? I mean, are there standouts, either positive or negative, in the other 5 countries?
I think they're like, most of them are going at a certain rate. I mean, she mentioned some delay, for example, PIT in one country or other, but I think a lot of the plans and the reforms are still going. I think with the new administration in Kuwait, there's some reform momentum there going. I mean, clearly a reform success story in terms of growth, diversification, and where they come from is Oman, which has really advanced quite a lot on its vision and its reforms, and has been able to deliver. So they've been chugging along with more or less different pace, and I think this is one and there are some examples within the GCC where you can see some that have moved a lot quicker than others.
Could you drill down a little bit more on Oman? Because when I was there earlier this year, I was pleased and surprised by what I saw as administrative reform and the way the government worked. I'm less comfortable with the fiscal strength, what they're doing on tax revenue, although they have, for example, put in a new social safety network that didn't really exist before, that they're trying to develop and expand.
Well, the reform, again, PIT was one of the planks, and I think some of those reforms are there to try to increase non-oil revenue mobilization. Clearly, on the business environment, they've taken quite a lot of action on the fiscal front to try to reduce the value. You've seen also the progress over the last 2-3 years on where they are on debt now. So they've been taking quite a lot of steps on trying to be prudent, even with the oil revenue that has come in, and making sure that this does not go into excessive spending like it was done in the past. And I think that prudence is what we need to carry the day going forward. And so that's on the fiscal, but at the same time, I don't want to underemphasize the role of structural reforms. And I think this is a good example of what's happening in the GCC, that each country is now spurring friendly competition with each other in trying to move up on reforms and seeing what benefits that can happen. And I'm hoping we can see, hopefully, also a move towards some harmonization on taxes, on reforms and things like that, which will make the GCC as a group stronger.
So I can't resist in asking a last question, given I have the mission chief for Saudi and the lead desk for Qatar here for any lessons, given Saudi has been awarded the Soccer World Cup in 2034, whether there are any lessons to draw from Qatar's experience of the World Cup for Saudi to think about, purely from an economic point of view.
I will let Ken, who worked on it for Qatar and also looked at the World Cup impact for Qatar, to start, and then I'll add 2 cents after that.
Great. Okay, thanks, Tim. I guess Saudi and Qatar have a very different economic structures, but maybe I can just start with how we see Qatar leveraged the World Cup before Amine comes in. So I think one lesson of success was that the Qatar really leveraged the global soccer game as part of its diversification strategy. So when we look back in the first half of 2010s, when the first national development strategy came out, the focus was a state-led growth using infrastructure as an enabler while improving institutional quality. So that's when the World Cup came in and all the infrastructure investment was done, led by the state. So in a way, all the $300 billion worth of investment that they reported in ports, roads, and the metros and so on, which would have been done anyway without the World Cup. But then the Qatar used the World Cup as a milestone to really accelerate the effort. So World Cup was very, in a way, wisely used in a productive way to push through the development strategy, which was already there. And then in turn, Qatar used the event to put the nation on the global map as attractive destination for tourism, for additional global events, which are still being hosted, and also for foreign investors. So all the high quality infrastructure that was built has been used productively. And also there was not a very large but positive spillovers to the regional economies as well, because all the spectators that came to Qatar, they had to actually stay outside of Qatar and then just come in back to Qatar for games. So maybe another lesson is that regional integration that we've been talking about can also be a beneficial angle, a way of leveraging future events within the region so that everybody can benefit from it and probably benefit even more than without having a stronger inter-regional integration. Thanks.
Just a couple of words on Saudi Arabia. Part of the vision already includes quite a lot on building sports and the sports industry. There's also quite a lot of events that are planned, from the Asia Games to Asia Cup 29, 30, Expo 30, the World Cup. And I guess, a lot of the infrastructure or investment that is being planned under Vision 2030 will support those events. And I think the way Saudi Arabia is looking at it is that those events will help make those investments, come more to the front and more profitable as opposed to new. I think it's too early for us to see, and we need to know more about what would be the additional cost that would come from these. Have these been planned? And what would be, I guess, a lesson is to make sure that there is a use of those facilities after. Look, a lot of the countries that have hosted these big events have not really always come out positive. And I think a lot of that is to make sure that the investment is an investment that's needed and can be used after. In Qatar, we've seen this increase in tourism post-World Cup that has been sustained. Can that be the case in Saudi Arabia, and what are the type of infrastructure that we need to be built to make those events also benefit the rest of the economy and continue after that? And we'll have to see, whether those, 15 stadiums, I'm told, but we already had in the vision that quite a lot of the universities will also have big stadiums. And is that a change? Is that not? I think that's still not clear, and we'll have to see how that works. But again, if we compare, I think it's better maybe to compare with other World Cups. If you want to compare World Cup, although some other countries that have done it are much larger than Qatar, I think to be able to see what it is. Qatar was much smaller population, Saudi Arabia with 35 million people and larger country. So we'll have to see how what will be the benefits there.
Good. Okay, so with that, I think I'm going to draw this to a close. I want to thank Amine and Ken for coming and sharing the report, and encourage everybody to look at it, available in the chat and on imf.org. Thank you all for attending in person and online, and hope everybody has a very happy holiday and New Year. Thank you.